Adrian Mowat, MD and Chief Emerging Market Strategist at JP Morgan Asset Management joins in. Adrian, hi, afternoon. Good to have you on the show. What is it that you're thinking in terms of what we're seeing for Indian equities today? Because it smells of basket selling by institutions today.
Yeah, just to clarify, I don't work for JP Morgan Asset Management. I work for JP Morgan, the investment bank. Look, we would need to put the Indian move into context. We've seen a sharp down move in Korean equities, Taiwanese equities, and Chinese equities today. So the Indian move is not disproportionate to that. But what is more topical, I think, with India is the movement in the currency. And the Indian rupee has been down 6% quarter to date, is one of the weaker currencies in EM, down, 16-odd% year to date. And we do, need to consider the interaction of India's current account deficit and its requirement for capital to keep on coming into the country, attracted by good investment opportunities. And unfortunately, the political situation and the corruption scandals are getting in the way of investments in the country, both physical and financial investments. And I think investors will be disappointed by today's news flow, whether it's the granting of bail for the 2G suspects, or the fact that it looks like the Lok Sabbath will fail to meet and agree anything again. We live in a world where there's lots of cheap stocks out there. There are other growth opportunities. And, if we're going to have a difficult investment environment in India, investors will vote with their feet.
Right. That's a pertinent point that you picked up, Adrian, at this point in time. You got the falling rupee as well, and of course a whole lot of corruption and scams as well coming up every then and now, and of course government inaction in terms of any policy moves. So at a time like this, how is the global investor approaching India? Are they going underweight? Are we seeing a gush of outflow from emerging markets like ours?
We saw significant outflow from emerging markets. This year it's been a trend, and that international investors, particularly those that look at the U.S. equity market as well as emerging markets, have found the U.S. equity market more attractive, giving better returns, and doesn't have some of the complications they have to take on in emerging markets. But that reflects the current positioning, and I would argue investors are underweight emerging markets at this point in time. When we review the major emerging market investors' asset allocation, there are the same number of clients who are overweight India that are underweight India, so there doesn't seem to be a strong consensus out there in terms of people's relative view on the Indian equity market.
Edith, you were earlier mentioning the weakening rupee as well. How big is it a concern at this point in time? Because, the only faction of the market which can arrest this fall is the Reserve Bank of India, whose hands as well as are tied, and we are seeing, no action coming in from there to arrest the fall of the rupee at this point in time.
Yeah, so, look, first of all, the rupee has weakened. It's down 6% since the end of September. In a world of emerging market foreign exchange, it's not a massive move. And it's hardly surprising considering, India does run a current account deficit. A lot of that current account deficit is a function of its energy import bill. And unfortunately, the oil price hasn't come down with other commodities. And if international investors and also local investors that have capital abroad are frustrated by the investment climate, then you're going to get a weak rupee, and there's very little the RBI can do about that. And I feel for the RBI. The RBI takes everything on their shoulder in terms of trying to manage the economy, trying to manage the exchange rate. And what we need is some leadership at the political level to break the bottleneck that's related to this corruption scandal, and to get India back to business and get India to take advantage of its extraordinary opportunities.
So, Adrian, I mean, what's the worst-case scenario that you're building in for the Nifty right now? We've already cracked below 4,700, which was acting as a floor for the market up until now. Could we see another 10-20% correction till the calendar year end?
Look, you could see further downside, because at the moment investors aren't particularly interested in putting in new capital into this market as it comes off. That said, I suspect that when you do your numbers, you will find that the Indian equity market moves pretty much in line with emerging markets. And my bias actually is to be a buyer in the current volatility and weakness. We are likely to see lower inflation in India as we go into 2012. We're already seeing lower inflation elsewhere in emerging markets. Most central banks are on hold. Some are cutting interest rates, such as Chile, Brazil, Turkey, and Indonesia. I think that'll actually prove to be relatively supportive. We see China experiencing a substantial slowdown in its fixed asset investment next year, which will be bearish for commodity prices, but that will help the inflation concerns and should be quite positive for India. So you're usually paid to take the risk when no one can see the upside, and they're very gloomy about the domestic conditions.
So, Adrian, pricing in all these scenarios, when can we see the first sign of recovery kick in, and a sustainable one at that, for Indian equities?
Yeah, look, I think the most important thing for Indian equities is to get this sort of horrible headline inflation number to a more acceptable level. And that could be quite easily a story of January and February, as this weak economy begins to be reflected in less pricing power. Now, obviously, the rupee has worked a little bit against that, in that imported inflation will be higher, but the economy does have some protection because of controlled energy prices. And when you start to look at the sort of year-over-year energy effect, it begins to look more positive as we travel through the first and second quarter.
So, Adrian, from now to Jan-Feb, which is when you see a constructive recovery actually kick in for Indian equities, for investors who are sitting on a pile of cash, should they start nibbling into equities from a medium to long-term time frame?
Absolutely. I think we have an extraordinary opportunity across emerging markets in the next couple of months for the disciplined to build up positions in strong businesses at low valuations. We've got lots of drivers of macro volatility. There's many things to be worried about, but there are things we've been worrying about all year, and I would argue are reflected in current valuations.
So, Adrian, what does one start picking up? Because, if you were to track the Indian earnings and, of course, the impact of the currency as well on corporate borrowings at this juncture, the next 2 to 3 quarters itself are looking quite bleak.
Yeah, so, what are you going to pick up in this environment? Well, I would take a contrarian view and look to pick up some of the engineering and construction companies with the naive hope that politics can't get any worse in India. I would also look at lower-end consumer stories. If we're right that inflation comes off, and that tends to benefit the lower-end consumer more than the higher-end consumer. Indian financials, if we're moving away from a tightening cycle, they could look interesting, particularly some of those that fund wholesale. So I think if you're willing to take a contrarian view, there are opportunities out there, as long as the valuations are cheap, and there are plenty of stocks around the emerging markets where valuations are attractive.